Today we're going to talk about buying a whole life insurance policy for life insurance versus buying that same policy for cash value. In the years I've been in this business, so many people have expressed an interest in whole life insurance. They're interested because they want the cash value. They see that it's a safe, liquid, tax-free place to put money. But when they finally see that proposal of them putting money in, they look at the cash value and they just say, why would anyone do this? Because the cash value looks so bad. So what we're going to go through today is what people are typically shown, call it the bad policy, because the majority of people who own whole life insurance own the product that you're going to see that doesn't look good. But then I'll walk through exactly how we can take that same product and make it look very good. Meaning, how do we take something that is ugly to many people and make it look very attractive? So, starting with the bad, what most people see when they request to see a whole life insurance policy or someone recommends, hey, you should look into whole life insurance, is usually a situation where they are quoted a policy. Here is a life insurance policy with a $1 million death benefit. And they're told they should have a $1 million death benefit or whatever amount of life insurance is being recommended for their situation. But how it works is they're recommended a death benefit, they're shown a premium, they're being told how much it costs, and they're told just to pay that premium, and eventually you'll see cash value build up over time. So when it comes to this approach, it is very expensive and not attractive at all for cash value. The thing is, when we take this approach, there are many different products that are available, and different products have different results. So if we were to look at one company, in this example, we'll look at Mass Mutual, and 3 different products with them, you're going to see premiums that vary drastically. First, we'll look at their traditional whole life insurance product, referred to as their Whole Life 100, then their high early cash value product, and then their 10-pay product. And what we're going to look at here is a $1 million whole life insurance policy where we are just quoting the premium. And again, after we look at this, then what we'll do is look at these same policies, but we'll go through how to design them for rich cash value from start to finish. So, to kick things off, what we have is the Whole Life 100 product. I'm going to walk through this on Excel. I just want to pull up the illustration very quickly so you can see everything directly from the company. So we have a Whole Life 100 product. We have a death benefit of $1 million. And there's your base premium, just under $20,000 per year. One other item to note is the first year cash value is 0 with this policy. Nothing to show for it, not attractive at all. And we're going to examine this further in a moment. Next, we've got our high early cash value product. So with this policy, high early cash value means you are going to have more cash value up front, even if you just buy a traditional life insurance policy. So here, we are purchasing the same $1 million policy. Instead of costing $19,000 and change, it costs almost $22,000. The difference is that instead of a 0 in cash value, you have very close to 80% of what you paid in the first year available in cash value. So this product is applying much of your premium to cash value immediately, which takes away that sting of seeing 0 up front. So this is a high early cash value product. Notice it costs more than the Whole Life 100. And then lastly, we have a 10-pay policy. So a 10-pay policy represents the fact that premiums are due for a maximum of 10 years. Now, when we look at the premium here, instead of about $20,000, it's more than $70,000 per year for the same $1 million death benefit. So we're paying a big premium for the same amount of life insurance. What do you notice about the cash value though? Not as attractive as the high early cash value product, up front that is, but long term you're going to notice it's much more attractive. But here's a way to illustrate how this product works. The Whole Life 100 product, the premium is the lowest at less than $20,000, because the premium is due until you're 100 years old. Whereas the 10-pay policy, the insurance company is saying, we're still going to guarantee that you have a $1 million death benefit, but instead of the premiums being due forever, they're only due for 10 years. So as a result, you, the policyholder, must pay a lot more money up front over this 10-year period in order for us, the insurance company, to guarantee you that same death benefit. Does it make sense as far as how it works? I wouldn't take this approach, by the way, but that's me explaining it from the insurance company's perspective. Let's take a look at these side by side, because I know going back and forth on PDFs can be challenging. So first, we have the Whole Life 100 product. When you pay money into a life insurance policy, you can choose where it goes. It can go toward the insurance premium or toward your paid up additions rider. In this example, we see that it is all going toward the premium, 0 toward the PUA rider. So your annual outlay matches your premium. With a Whole Life 100 product, which is a traditional life insurance policy, your first year cash value is 0. What's highlighted in yellow is your break-even point, which is the first year your cash value is equal to or greater than your total payments. So you had to wait 14 years before you see any type of gain on your cash value. This again is a traditional approach, not that attractive in my opinion. Here's the high early cash value policy, which looks a lot better up front because I've got about 80% of what I pay into the policy in cash value. So it's still all premium, no PUAs. There's my first year cash value. The break-even point, however, still takes more than 10 years. It's 11 years in this example. So granted, the upfront cash value is much more attractive, it's still taking 10 plus years before I see any type of gain on this policy. And I'm paying a higher premium for it as well. The reason why I'm paying more though, is because with this guy, the Whole Life 100, premiums are due until I'm 100 years old. You don't have to pay it that long. You're going to see that in a moment. Whereas with the high early cash value product, premiums are contractually due until I'm 85 years old. Whereas with the 10-pay policy, premiums are due for 10 years from the date that I start the policy. So after the 10th year, there's no more premium due. That's the advantage here. Now, what do you notice about the cash value? When's the break-even point? It's much earlier. Year 9. So the 10-pay policy, I paid a whole lot more money into the product. So most people would likely view that as expensive when they compare it to this guy. If I'm just looking for a policy for a $1 million death benefit at the lowest out-of-pocket possible. However, what I get in return is more cash value because I'm paying a larger premium. And also, if we slap a rate of return on this, you will see a much stronger growth rate as the years pass as well. However, this entire approach is not something that I would recommend. This is building a policy for life insurance, which means we just plug in your age, plug in death benefit of $1 million, and click calculate, and it spits out what you just saw. That's it. Very simple. This is often viewed as expensive. It takes too long to see any real value when I'm looking at the cash value. Yeah, eventually I see cash value, but it's not attractive at all up front. So how do we take what we just saw, an ugly whole life insurance policy, and make it look good? Not just good, but beautiful. Instead of me telling you, here's a $1 million death benefit, and here's how much it will cost, throw that approach out the window. And I would say this, if I'm you, here's how much money I want to put into this policy. I don't care about the death benefit. Cash value is my goal. If that is truly how you feel, express it, because letting an agent know that will allow them to design the policy in a manner that is truly in your best interest. And if you get an option that looked like the ugly option, send it back. Just like you getting a steak at a restaurant that is not cooked the way you ordered. Send it back, especially if it's raw when you cooked it, when you ordered it well done. Like, no, we want it done right. So in this example, we'll look at someone who says, I want to fund a policy with $50,000 per year for 10 years. That's how much I want to put into this policy and set it up for cash value. So what we'll look at here are the same three products, except here, we're just going to focus on maximizing the cash value. So let's take a look. When we look at the illustrations, we've got the same three products. There's our Whole Life 100 policy, $50,000 per year for 10 years. Where we can see that is here. The difference is this. Death benefit with this product is actually a little bit higher. Here's where your money's going. Up here is the premium. And then down here, these two guys represents the PUA rider, plus a small amount of money is satisfying the term insurance cost. But this product, your Whole Life 100, what was the cash value in the first example? It was zero. Remember that? What's it here? It's not zero. $42,000. Do you remember how long this option took to break even? It was about 14 years. Here, we get our money back in 6 years. Same exact product, same exact insurance company, same individual. The difference is we, the policyholder and agent, are choosing where the money goes. That's the key difference here. Same thing if we look at the high early cash value policy. So next, same thing, $50K per year for 10 years. There's the premium. There's your PUA rider. Look at your first year cash value now. More than 90% right out of the gates. Break-even point is the 4th year. And then the same thing if we look at the 10-pay policy. We're putting this guy on steroids here. So same $50K per year. Here's your premium. So what's the lesson here? With a whole life insurance policy, instead of me telling you, here's how much it will cost you, you can say, here's how much I'd like to fund this policy with. It could be $50K per year for 10 years. It could be $5K per year for 10 years. Or maybe it's $100,000 per year for 5. Or maybe we discuss it and come to an optimal funding solution. My point is, we, instead of just price quoting it, can say, here's how much I'd like to allocate toward this policy, but my goal is to have as much cash value as possible. I don't want to get into a situation where I get this policy, I think that it's a great policy, and I find out after the fact it's not. This happens so much. It's where buyer's remorse occurs the most. People think they're getting a good deal, and they find out after they've dedicated their money that it's not the case. Like, it doesn't work. It's your money. It's people's money that we're dealing with. Like, you can't do that kind of stuff. So let's look at a side-by-side here. Same policies we'll look at, just the good ones now. the good ones. So here's the first one we looked at, our Whole Life 100. $50K per year going in. What's the difference though? Well, there's your base premium, $5,000. There's your PUA, $45,000. Much more cash value. Instead of taking 14 years to get our money back, we got it back in 6 years. This is the least attractive products among Mass Mutual products if cash value is your goal. This policy is specifically designed for death benefit. Now, if you got a Mass Mutual policy before the year 2022 and your product is called a Legacy 100, then that's not the case. That product was actually sweet back in the day before there was a big industry update. So since the industry update, we don't use this product that much because it's not as attractive as it used to be. But if you have the old one, you are locked into that. Here's why I say that though, about the new one. If we compare it with the high early cash value policy, same design, same minimum premium of 5, same PUA rider, same net out of pocket, 500K per year, 500K over 10 years. By the fourth year, you have paid in a total of 200,000 and you have 200,000. That's your break-even point. After that, you just let it cook. Which one has the most money from start to finish? More up front, 46 compared to 42. At the bottom of this chart, at age 71, whole life 100, 1247, high early cash value, 1292. Same company, same design. What's the difference? Different products here. What do you trade if this is you? Death benefit. Almost $200,000 less right out of the gates. Now, as time passes, if we scroll down, you will see the high early eventually has more than the whole life 100 product. Last item, 10-pay policy, the good one for this particular situation, that is. So, same thing with the minimum premium, PUA rider, annual outlay, 50K per year. First year cash value, just about 45,000. By the fourth year, this one is the strongest. Death benefit is the lowest initially. What happens by the 10th year? Cash value, 607, death benefit, 1.4. The cash value with that 10-pay product is noticeably higher than the other two options. Yet the death benefit is in favor of the whole life 100 product because this product is designed for death benefit. Now, if we scroll down, let's do that. What does it look like by age 80? There's your whole life 100. Cash value in the whole life 100, 1.92. Death benefit, 2.5. High early cash value. Cash value, 2,021,000. Death benefit, 2.5. Slightly less than the whole life 100. In life insurance, about 100 grand more in cash value. How about the 10-pay? Cash value, 2.27 compared to the high early that just cracked 2 million and the whole life 100 at 1.9 and change. Noticeably more cash value. How about the death benefit? Noticeably more too. I'll close with this. When you design a policy for high cash value, meaning you take the ugly one and make it very, very pretty, what ends up happening is you've got more cash value up front. That's what everyone looks at. That's the attractive part of the policy. But then the death benefit. The policy that has the most cash value long-term will also have the most death benefit long-term. The reason why is if you ever look at a life insurance illustration, a whole life insurance illustration, what you'll see in most cases, the cash value and death benefit are going to be the same when you are 100 years old. With some products, it's 121 years old. My point is, eventually they become the same. So if I know the 10-pay product had the most cash value long-term, especially by age 100, that means the death benefit will be the highest at that point in time too. Usually between age 75 and 85 is when I would see a high cash value product also have more death benefit than a product that had more death benefit up front. Hope that makes sense. So to wrap all of this up, looking at a policy that is designed for cash value immediately, I see cash value immediately, which makes it much more attractive. And the big thing is I can use it now. That's often what folks are attracted to when I look at the whole loan feature, where I can borrow against it while it keeps on compounding. So I hope you enjoyed this video. I'd love to hear any thoughts, questions, or comments you have. Feel free to leave them in the comments section below. You can also DM me on Facebook, LinkedIn, or our other platforms. And as always, I hope this helps.